Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Monday the 7th of April in London. I'm Stephen Carroll.
And I'm Valerie Teitel. Coming up today, the global stock market meltdown is getting worse as tariffs, recession fears and growing retaliation concerns send investors fleeing from risk assets.
Donald Trump rejects the reaction from traders as he remains defiant on his global tariff barrage.
And the only certainty is uncertainty. Bill Ackman warns of an economic nuclear winter as Keir Starmer says the world as we knew it has gone.
Let's start with a roundup of our top stories.
Global equities are plummeting again today as investors continue to fear Trump's tariff salvo could lead to a global recession. European shares have opened sharply lower. The Eurostoxx 600 is down 5.8%. In Asia, Japan's Nikkei 225 entered a bear market, falling 20% from its high in December. The MSCI Asia Pacific Index having its worst session since October 2008. Futures are pointing towards heavy losses on Wall Street. S&P E-minis down 3.8%. The head of economics at Renaissance Macro Research, Neil Dutta, says markets are sending a clear message.
You're getting to a point now where I think the market will take on more of a role of like an active informant, where it begins aggregating macro risk factors and outcomes, and it tells you about the future. And then the stock market does kind of take on this macro role, and that's kind of where we are. So if the stock market goes down, that creates a way of tightening financial conditions, exacerbating the uncertainty that's already out there, and you continue to have a negative feedback loop until policy gets investors to shift their attention.
Neil Dutta was speaking as the global rout in equities was matched by a surge in the so-called fear index, the VIX, which is now at levels not seen since the pandemic and crossed the 60 level at the open.
President Donald Trump and his team are doubling down on their tariff plan as he and his economic team dismissed investors' fears of inflation and recession. Speaking on Air Force One yesterday, the US leader struck a determined tone and repeatedly defended the measures unveiled last week.
I don't want anything to go down, but sometimes you have to take medicine to fix something.
In comments that may fuel further market fears, Trump said he wouldn't strike deals to cut the highest tariff rates unless countries eliminate their trade deficits with the US.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country.
Trump's insistence that trade deficits need to be balanced to gain tariff relief will cause concern in many countries, as delivering on that aim would be entirely separate from eliminating any trade barriers or tariffs they may have on the US.
Trump's comments are the latest in a parade of defiant signals from the president and his top economic advisors. The U.S. Treasury Secretary Scott Bessent, speaking on NBC's Meet the Press, rejected the idea that they would cause a protracted U.S. economic contraction.
I reject that, the assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
Treasury Secretary Scott Bessent speaking to NBC's Meet the Press. Bessent said more than 50 countries had called the White House seeking talks, but that any negotiations are going to take time.
Prominent investors and traders have also been posting on social media to make their views on the tariffs clear. Bloomberg's Ewan Potts has more.
After two trading sessions which saw $5 trillion wiped off the value of US stocks, America's investor class is coming to terms with its new diminished status in the era of President Trump's trade offensive. Bill Ackman, the founder of Pershing Square and vocal Trump supporter, posted on X that he strongly believes launching tariffs against the entire world is a mistake. Ray Dalio, the founder of Bridgewater, the world's largest hedge fund, warns the tariff package will be significantly stagflationary for the United States. Ackman went on to say the White House should call time out on the plans. He says otherwise we're heading for a self-induced economic nuclear winter. In London, I'm Ewan Potts, Bloomberg Radio.
After the events of recent days, economists at Goldman Sachs have raised the probability of a U.S. recession from 35 to 45%. They now expect the Fed to deliver 3 consecutive 25 basis point insurance cuts starting in June, but warn the central bank could deliver much deeper cuts in the event of a recession. Here's Bloomberg opinion columnist Mohamed El-Arian.
I think the hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be? And I'm saying that because we have technicals playing in. Margin calls are there. People are, in fact, reducing winners and losers across the board to raise cash. Fund managers are worried about actual and expected outflows.
Mohamed El-Arian speaking there as Goldman Sachs economists said their baseline forecast for some growth still rests on the assumption that U.S. tariffs will be reduced from their current level.
China's policymakers are discussing front-loading stimulus to counter the hit from Donald Trump's tariffs. Bloomberg has learned senior officials discussed new export subsidies and a stock market stabilisation fund. State-run media also talked about domestic demand becoming the long-term strategy for economic growth. And the Securities Times reported that Chinese sovereign fund Central Huijin is actively carrying out market stabilisation operations today as the onshore CSI 300 index of shares saw its biggest declines in more than 5 years.
UK Prime Minister Keir Starmer says he'll announce new measures to support British businesses in the face of the global trade war. Writing in a newspaper over the weekend, he said the world as we knew it has gone. Treasury Minister Darren Jones says the support package will involve investment in industrial policy and public services.
Globalization, as we've known it for the last number of decades, has come to an end. That's why we need Britain to be strong and resilient, also build out our relationships with our allies and partners around the world, but also why we have to invest in the domestic economy, both for UK businesses, but also our public services, so that we have workers and communities who are well skilled, able to take advantages of jobs.
Jones gave no details, but after he spoke, the UK government announced it would ease its green targets for car makers. Britain has so far said it won't retaliate against Trump's tariffs as it hopes it can secure a deal with the United States.
Finance ministers from Italy and Spain have warned against reacting too aggressively to Donald Trump's tariffs. There are marked contrast with a push by France and Germany for more forceful reaction. Miguel Berger, the German ambassador to the UK, says trade ministers are drawing up a list of potential countermeasures.
I think it's the biggest assault we have seen since the end of the Second World War on global trade. We all will have to find a way to deal with it, and European trade ministers are going to meet on Monday and then take a decision on how to react.
Germany's ambassador to the UK, Miguel Berger, speaking there ahead of the meeting of EU trade ministers today in Luxembourg, focused on the levies. His comments come after European Central Bank Executive Board member Isabel Schnabel suggested that US tariffs may signify that the era of free-flowing global commerce is over.
Those are your top stories on the markets. The Euro Stoxx 600 in its first hour of trade is down 5.1%. Losses are being felt across all sectors. The Euro Stoxx 600 banking sector is down nearly 6% on the session. Over on Wall Street, S&P futures down 3.6%. NASDAQ futures down 4%. In FX, the Bloomberg dollar is 0.1% weaker versus peers. Across fixed income, a big rally in the front end. Two-year yields in the U.S. down 13 basis points, down 15 basis points in two-year Germany.
Okay, so Valerie, we are very lucky to have you with us for this hour on Bloomberg Radio, as you are, of course, our markets voice during the programme and across Bloomberg Radio and television as well. And this is the day to be thinking about the scale of the moves that we're seeing. Looking at the Stoxx 600 being down, and in fact all of the European markets down over 5% as well. Looking ahead to what's happening on Wall Street as well, we're in for another pretty bruising day ahead.
Yeah, if this move in the futures market holds until the close, Stephen, we are looking at the worst 3 days for the U.S. equity market since Black Monday back in 1987. Even the 2-day move, though, from Friday and Thursday of last week stands out as one of the worst 2-day slides that we've seen. It joins the board with the slide of 1987, with the slide of the global financial crisis, and the COVID slide back in March 2020. And what a pummeling session when it comes to Asian equities. A lot of these Asian indices had their worst session since October 2008, and they closed at the lows.
Yeah, I mean, look, the Hang Seng down 13%, pretty astonishing there. Let's dig into some of the other sides of these trades, though, as well, as investors have been looking for haven assets, and a big rally in bonds we're seeing as a result. Our managing editor for FX and Rates, Rachel Evans, is with us as well. Rachel, looking at the moves on European yields, first of all, this morning, I mean, German's 2-year yield down 16 basis points. This feels like it's accelerating from last week.
Yeah, I mean, we're starting to get that feeling that, this isn't going to be necessarily contained to a few days, with the moves kind of very much going far beyond US assets. I think like last week, the US was very much kind of front and center, and that was really where the worst of the action was. That still kind of holds today, but we're starting to get, a little bit of a bigger move kind of coming through into European assets as well. So we did see the 2-year yield on the German Bund actually falling 20 basis points at one point. And I was really taken last week by the fact that, by the end of Friday, we'd actually seen all of the big yield surge that we saw in the wake of that fiscal plan that Germany announced at the beginning of March, just a little over a month ago. That feels like a lifetime. That's all gone. And we're kind of back, on the 10-year to yielding basically the same before that that fiscal spending plan was announced.
But Rachel, we're seeing these big moves in yields, but not equally spread across the European economies either. I note that Italy's yields aren't moving anywhere near the same size, and the spread there really blowing out between German and Italian yields. What should we be reading into that?
I think it's really just at this point kind of a sense of, risk on versus risk off assets. Bunds are definitely getting a bid because they are seen as kind of the safest asset in Europe. So if you're not interested in treasuries, and maybe the appeal there has diminished somewhat given that, the US sort of framework for treasuries and for US stocks seems to have weakened. You can't necessarily rely on the US in the way that maybe you once were. That whole US exceptionalism story is kind of fracturing a little. Maybe you'd go into bunds instead. They've always been kind of Europe's safe haven, whereas on the Italian side, that's very much still counts as a risk asset. Obviously Italy has had a lot of debt issues over the years, so investors tend to get out of those sort of bonds more quickly than they would something else. So I think that's what you're seeing really. There's kind of just sort of this preference for safe havens and flight away from risk assets.
And Valerie, the question of volumes kind of key to watch here when we're thinking about the context for these size of moves that we're looking at.
Yeah, it's interesting to note that in Friday's S&P 500 slide, there was a healthy volumes going into that. So this is a market that is still functioning properly. And that's one thing to note, because one thing about the COVID slide, I mean, that was nasty on all levels because the Treasury market essentially broke. We're not necessarily seeing markets breaking in that terms. Even in the Asia session overnight, the Hong Kong stock index saw a record amount of turnover. To me, that it's a healthy market slide, if that makes sense. We're not seeing these gaps lower on no volume. So in that way, maybe is one thing that can make us feel a bit more positive about this move, is that we're not necessarily seeing a massive gap one way or the other.
You've been looking at the European banks moving this morning, because that's been kind of one of the dramatic sets of moves we've seen, among many, we should say. But does that necessarily translate into the Wall Street session later? I
think so, because the banks, the decline in the Euro stocks banks is basically a reflection of credit spreads widening and the market positioning for a slowdown where, we see bankruptcies. So those high yield junk credit names, the probability of bankruptcy goes up, which means that banks will be holding more losses on those loans. That was something that was mirrored in the U.S. session as well. So the dynamic isn't just isolated to here in Europe. Credit spreads are widening globally. We even saw it in Asia. Even the CDS spreads on some of these Asian nations blew out as well. That's just, the market really questioning the business model of some of these nations if these tariffs are to stay in, for some time, for a matter of months. The Eurostoxx Bank Index, that's SX7E, is down 19% in the last 3 days. That's definitely something that I'm sure the ECB does not want to see.
Rachel, thinking about where we go from here, what sort of catalyst do markets need to see any reversal of the sentiment that's driven us to where we are now? Donald Trump says to forget about the markets. Will they start looking elsewhere for catalysts?
And I think, there was a lot of attention on sort of Jerome Powell's speech on Friday, kind of this hope that, if there wasn't going to be a Trump put, if Trump wasn't going to come in and save the market, that maybe there might be still the lingering hopes of a Fed put. And certainly, Powell's kind of comments on Friday suggested that they're very concerned still about inflation and whether tariff brings, an inflationary impact, whereas I think the market is more focused on the growth impact. I think if that starts to change, that's the sort of thing that could go either way. You could see that as, a sign that, all things things are so bad that the Fed has to kind of change its stance, panic time. Or you could see people taking some reassurance from the fact that the Fed will step in. That the market is starting to kind of price in a May cut more seriously. We now see that as more than 50% likely. And there are also the beginnings of bets on the potential for an emergency rate cut. Now, that's definitely not the base case scenario, particularly as we don't have a May cut fully priced in yet. But those are the sorts of bets that are starting to be placed, because I think everyone is so in need of some sense of stability and are looking to try and find it kind of anywhere they can.
And just on the question of volatility, Val, we have seen that spike in the VIX this morning. A pretty significant move in that fear, that gauge of volatility. I mean, how rough is today going to be on Wall Street?
The VIX, when it did open up, which was just an hour ago, crossed the 60 level mark, which is something we haven't seen in some time. And, it goes back to saying that the 3-day slide that we've seen in the equity market is lining up to be one of the worst that we've seen since World War II.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.